Hi everyone, I thought I would take some time to walk you through the federal budget of 2026 that happened last night at 7:30 p.m. Effectively, there's three big property tax changes that are being announced. It's not yet law, but again, it has to pass through parliament and all these things, but it's really good to know in order to understand what that means for you. So there's a lot of commotion at the moment about this, and I've tried to simplify what the big three property tax changes are. There's two schools of thoughts that I'm hearing at the moment. One is panic mode, and then the second one is like just ignore the noise. Lots of things have changed in the past, and that is true. So, whether we went through the financial crisis, there's been significant changes in the last, 10, 20, 30, 40 decades in terms of the property space. And, there's still strong economies within economies. But that being said, I am a person who always advocates for education, so becoming a smart investor, an intelligent investor in terms of understanding, not ignoring the noise, but understanding what does that mean for me, what was it before. And what I like about this is that it is forcing us to take a step back and take a look at what it is that we had accepted or taken for granted. It's making us use our brains, as my dad says. What does this mean? What have we been doing in the past, rather than just following the bandwagon and jumping on the train? What does that truly mean for me? And I think these hard conversations is what it is forcing us to do, especially in today's environment with everything happening at a global level and what is going to be happening in the future. It becomes much more paramount to have these conversations and really take ownership of our position, like where we're at, our finances, our lifestyle, and our goals as well, and how do we optimize for that. That's why I'm always an advocate for strategy. This is something I learned at Deloitte in my foundational years. I've been there for over a decade, and as a chartered accountant, I always put like a CFO lens on, okay, how do we optimize this? What is the risk mitigation strategies? What is the sensitivities that we need to factor in tomorrow, 5 years, 10 years time type thing? So without further ado, I think they've done, and again, I'm going to leave politics, or I'll try and leave politics behind and talk you through the facts, but it's also really good to understand the substantive substance over form. You're kind of saying one thing, but how you've structured something is actually not substantive to the direction of which you've set or what you've said. And what I'm trying to say is that, you're not really helping the buyers get into the market, but you might be helping yourselves as well. And so the intention with which rules are set, you always try and think, who is this going to benefit? What are they trying to motivate me towards? And fundamentally, does this make sense for me? And, I always say trust, but verify. And so when you actually work out the pros and cons for yourself, you'll be able to make a more informed decision, not just with confidence or clarity, but with more conviction that, okay, I understand the pluses, the minuses, the holistic bigger picture from a completeness point of view. And then you'll be able to be like, all right, now I see how I can actually get ahead. Okay, so let's start with the first one. So effectively, the big three tax changes relating to property is the number one, negative gearing. For those that don't know, negative gearing is basically a tax advantage that a lot of smart investors or property investors utilized in order to kind of get ahead or manage their cash flows a bit better in terms of getting a cashback or a decrease in their tax paid at the end of the financial year. So for example, to simplify it, someone who's a 47% high tax bracket earner, they would be paying the ATO back quite a large chunk of money back to the tax because of the way because they don't have any deductions because of the thresholds and the calculations. And so what the legal rules allowed at the time was to claim negative gearing benefits. Now those negative gearing benefits is things like your rent, your expenses, depreciation, and quite a few costs related to your investment property that you can offset your taxable income, such that you pay less tax. So you might be 47% bracket, but when you work out your actual marginal tax, it's much less because you've actually offset all of these deductions. So basically, in a nutshell, paying less tax basically is what negative gearing is. And you'll find that a lot of investors would, especially when they start having portfolios, this is probably when they are mostly leveraged, so they have a lot of debt. They would probably be relying on that for the most part, or the majority of investors, in order to make sure that they can hold their asset and keep going in terms of getting that. So what they've done is basically said from the 1st of July 2027, negative gearing won't be available for established properties after the budget night. So basically from last night at 7:30, if you have signed a contract, after this date, from last night till future, you basically on established properties, you are not eligible for negative gearing. So let's say, for example, your property is, when you work out the maths, your holding cost is minus 15,000 annually to hold that asset. Most of the times you get a, say, 30% rebate on your tax on that, so you don't have to pay 15,000, and you can reverse engineer how much savings and how affordable it is to hold that asset. But again, the future rules means you cannot actually offset that against your wages, and so you'll have to basically pay that. So cash flow becomes quite important in that respect. Now, if you're an existing investor, your existing investments are grandfathered. So what that means is that this rules has no impact for you because you'd actually had made those financial decisions previous to this new law coming. So again, it's prospective. So it's in the future, not retrospective. So these rules are grandfathered. So no issues to note. If you already are utilizing that, you can still continue it until you sell the property. And we'll come into that selling part with capital gains and what that means in a second. But the key takeaways is the tax advantage moves to new homes, supporting supply and not existing stock. This is a key takeaway because negative gearing is the tax benefit. So for every $1 you spend, you save 30 cents. High level. Obviously, there's many nuances to this. But if we take a step back, what is your strategy? Is your strategy to find a property in order to only spend $1 to make 30 cents? Realistically, that shouldn't be the full holistic picture, but it does help high income earners that are paying a lot, and it also helps those that want to scale and build a property portfolio and that are highly leveraged. So they need that cash flow in order to kind of continue on the journey in terms of holding the property. So yes, some people say that effectively there's no impact because net by the time you sell the property, these losses, you can carry them forward. Yes, you can carry them forward, but if you look at the time value of money and you look into, for example, how much that extra 4,000, 5,000, or even some people 6, 7, 10,000 in this financial year, that might really help you get ahead this year than waiting 10, 15 years time in terms of what we call the power of compounding. And that is the power of compounding in any discipline of life. We know the power of compounding from interest rates. So we know if we buy a $700,000 asset, you're paying nearly much more than that in interest, right? So the power of compounding in any respect, discipline in life. If you wake up every day, go to the gym, power of compounding. So nothing replaces that power of compounding, which will accelerate your wealth on a year-to-year basis than selling it in the future. And again, I don't want to jump the gun too much, but effectively with the CGT, even if you do sell the property after 10, 15 years time, that would only be applicable on the gains you made. So it's called capital gains. So the government really thought this through. How do they think this through? Because with negative gearing, they've only made it applicable for new builds. And we know from the data, we know from new builds analysis in the last 10, 20, 30 decades, new builds in general do not perform as well as established properties. So they're trying to kind of shift the balance in that. I know so many of my clients who have purchased new builds 15 years ago, 10 years ago, that actually for 700, 800,000 that are actually now worth 600, 750,000. So effectively there's no gains on that. So again, there's nothing to be earned. So effectively we talked about negative gearing from 1 July onwards. You can claim negative gearing for new builds. What they're trying to do is incentivize us to purchase brand new buildings. The underlying meaning or the underlying message is here. The government every single year, as we know, every month, every quarter, we are behind in supply. We at the moment cannot even afford to help the Australians find really good rental properties. There's a shortage of rentals, let alone there's a lot of migration coming in to the country. That's not going to disappear. So the government has not been able to solve that. And what have they done in order to have a short-term kind of I call it a cheat. They've kind of put it on us to be like, okay, you guys will be incentivized to, build properties, and basically they're looking up to us to create the supply. This is a bit risky because I understand the theory, but the reality is a large portion of Australian investors are privately held, not from the government. And basically most people in Australia are renters. And in terms of the renting part of it, if you take away negative gearing, this will mean rents will increase. So this is not really helping people get into the market because, one, they won't be selling the established properties because of the capital gains tax that they've introduced. Second, you're actually hurting the people that you're trying to help because the rents are going to increase. That is, if you think of just a few years ago in 2022, I believe, or just after COVID, there was a massive increase in rents because what happened is the vacancy rates were already tight and they became tighter because there was just no supply, right? So the same thing will happen, and with the investors being privately owned, they won't be able to afford, especially the new investors that have purchased in the last couple of years, and they were heavily negatively geared. How are they going to pass this on? So that's one thing to be mindful of and take note of. But the key takeaway here is the law, or the potential upcoming law, is that the incentive for negative gearing will be buying new builds, but caution. So be ahead of the curve, educate yourself, become a smart investor, and know what it means for you, and don't just walk in blindly. Really understand where they're coming from, what that means, what the impact is, and then go from there. Okay, so capital gains tax, CGT. For those that might not be aware, if you're an owner-occupied and you've purchased your own property, you are exempt from CGT. So if you live in the property and you sell it, you don't pay any tax. Now, capital gains tax, there was a rule where if you were an investor, you needed to hold your property for 12 months before you sell it, and then you only pay tax on 50%. So you got a 50% discount. Whereas now, from 1 July 2027, it's moving from 50% discount to 30%. But what they will do is they'll basically take into consideration inflation adjusted. So they take into consideration the time value of money so that you pay tax on the real gain above inflation, which kind of makes sense from mathematics. But again, the time value of money in terms of the compounding effect, if you were to sell in 10, 20 years time, that 16,000, even from today, if we look at 16,000, 10, 15 years ago, it would have been much more valuable for us to get into the market or get into certain type of asset investments earlier than that 16,000 would be in 10, 15 years time, if that makes sense. And again, I mentioned very many times, and I want to push hard on this because new builds is not a smart investment choice, and cash flow doesn't build wealth, right? So the premise for those that are astute investors, or that know or have been following and educating themselves in property investing, cash flow does not build wealth, it's capital growth. And in new build properties, there is very high likelihood that you will actually not build equity, but you will actually have negative equity, which means that the price that you bought it for will go down, especially in areas which have high supply. It's all fundamentals of economics, just like supply and demand, if you think of it. But it's also the type of asset, and what becomes more and more paramount with both negative gearing and capital gains tax is cash flow management and risk mitigation, as well as structuring. That's why strategy will become more and more important, especially with property investing and getting ahead, especially in today's economy. So key takeaways: capital gains tax from 1 July, CGT tax rules are going to change from 50% to 30%, obviously inflation indexed method. New builds, again, you can see the recurring theme: retain the choice of 50% discount on the new method. I'm going to hone in on this again because quality assets and long-term ownership still win 100%. I'm going to go back to the negative gearing. You want to pay $1 to save 30 cents. Does that make sense? Holistically, it's like saying I'm going to go to school, go to university so that I can start working and get 28,000, exempt tax-free threshold. Is that the reason why we go to work? So in the same way, that kind of example is the same sentiment that I want to hone in for educated investors and smart investors, because we don't invest in property to save on tax. You have to look at the bigger picture, and this is where people kind of look at all the small, minute details and forget overarchingly what is the umbrella goal? Where is it that I'm heading, and how can I get there the most optimal way, the safest, risk mitigated way, and so that I can protect myself, my family, and my future. The third one is trusts. So a lot of you probably know about creating discretionary trusts, and that was sort of like potentially a loophole where discretionary trusts didn't really have tax. So especially with low income earners, you could actually distribute the benefits to members in the family. So from 1 July 2028, they've introduced, or they will be introducing, minimum of 30% tax on distributions, effectively just to keep it fair in that respect with people that are working, which I think makes sense. There will be a rollover relief for 3 years for small businesses and restructuring, and this is something I'll definitely recommend you guys to speak to your tax accountant and get some advice if you are going down that route, just to know what it is that will be best for you in your situation. I always say, strategy is always tailored where you are, where you want to go to, and how do you get there. There's never any cookie cutter principle. Like if you think about a nutrition plan, there's no follow this nutrition plan and you'll get a six-pack or you'll be fit and healthy, because every single individual has potential preconceived conditions, health issues, potential lifestyle, sleep, vegetarian, non-vegetarian preferences. Maybe their goal isn't to get a six-pack, maybe their goal is just to feel more energetic, etc. So the point I'm trying to hone in is that every individual is different, and a tailored strategy from nutrition plan, going to the gym, it's not IKEA cookie cutter. And so tailored is really what we're after, especially in today's economy, to get ahead. Okay, so first home buyers, government is focused on basically trying to increase supply, but I don't think they will be successful in this. Why? Because, as I mentioned, the cost, the risk of new builds with everything that's happening in the economy, it will not be worthwhile in order to get there. I think the strategy will change to more balanced in terms of, okay, for those that are wanting to purchase in city metro areas, they might get priced out because obviously borrowing capacity caps and things like that will come into play. So they would have to basically move to other areas or change the type of class of assets, decrease their purchase price, and the focus will now be on the more affordable suburbs or areas, and this is the areas that I've been purchasing for in the last 3 years as well. So that doesn't change in terms of our strategy that we've been doing, but it changes a lot of things in terms of the individual, where they are starting from, what we can leverage, how we can get them to accelerate their journey and compound. How do we structure it so that they're protected, and then the opportunity costs of all of these things and how we can optimize it for them. So the new investors, negative gearing, unfortunately for really smart investors, the intelligent investors were purchasing in existing properties rather than house and land packages, rather than off the plans, all these schemes of high cash flow, because cash flow doesn't build wealth. Cash flow in these areas, normally you're getting extra cash flow at that point in time, say $20 or $100, that's $5,000 a year. But capital growth in established areas, you can look up to 80 to 100,000 per annum in terms of building that wealth. So for those that might not know, this is just a summary of what smart property investors do in terms of getting ahead and building wealth for financial security. And so I can see why they've grandfathered it, because basically people that are much older, the intergenerational wealth, they are ahead. They won't be affected as much as the people starting out. Why? Because the type of asset that they're incentivizing new builds. New builds are not a quality asset. Cash flow is not king. Cash flow doesn't build wealth. It's basically like saying, I'm going to get a job and live paycheck to paycheck, but the incrementals of your salary isn't going to make a big change in your life, because most of us have been working in a job for most of our lives, or still working, right? So we need to really understand, how do we get ahead in today's economy, and really take a step back and be a bit more responsible, be a bit more self-aware, and really take accountability of our lives, because things are going to change if these are passed in Parliament. Yeah, I quite like that these changes have happened, because it's forcing us to rethink outside the box, rethink why we started, rethink what are we doing, why are we doing things, so that way it really hones in that strategy is critical, from cash flow management, from structuring, from the type of asset, tax optimization, multiple things, risk sensitivity analysis, etc. And the last thing I want to do was share with you an example So let me pull up this example just so it'll be helpful. Okay, I wanted to share with you guys an example of the current system just so you can see or you can understand the numbers, because I'm a chartered accountant. That's in my nature to understand the numbers. So if we actually look at the current system, we've got let's say negative gearing, that's still applicable, plus 50% CGT discount. So if we got, let's say, a negative rental loss of 10,000 per annum in 5 years, that will be 50,000. And let's just say our tax refund is, let's say, 30 plus 2% Medicare levy, so that's 32%. So at the end of the day, in 5 years' time, we'll have 50,000 rental loss, and then we've got a refund every year of 3,200. That's 16,000 refund. So our net cash cost to us as an investor is 34,000. So effectively, what this means is that it makes it more affordable every year to kind of reverse engineer from our savings how much do we need to save, and then from the benefits it kind of, really gives us that buffer to maintain or buy a second property or third property in terms of serviceability and holding costs. That's the current system. Now let's just take the example that in this particular scenario, after 5 years we've sold the property, we've made a capital gain of 200,000. So the 50% discount basically means that we're not taxed on the 200,000 gain, we're only taxed on 100,000. So 32% of 100,000, that's 32,000 tax. So same scenario, 200,000 minus the tax that we pay, 32,000. Net after tax profit that we keep is 168,000. This to the proposed system, I'm just going to keep the CGT the same at 50%, but have no negative gearing. So just so we can compare the two side by side. So again, same scenario, we've got 5 years, rental losses, negative 10,000 per annum, that's minus 50,000. There's no immediate refund or tax benefit because there's no negative gearing. So the net cash cost to us is minus 50,000. So again, divide that by 12 and work out, that's nearly a third that you have to cop out that you would have had in your pocket, or a bit more buffer because of the government incentive legislation at the time with negative gearing. So that's going to impact if you want to go again in 1 or 2 years' time, or if you actually have to sell your current property because you bought a $1 or $2 million property in Sydney, for example, or you need to change your purchase price. Again, there's multiple areas here to consider, but let's keep it simple. What does that mean from a cash flow point of view? So now the true current situation, 50,000 is effectively the amount that we cannot claim. So it's still the same scenario. We've got a $200,000 gain. Now the CGT is 30%. So the discount is 30%. So effectively we get taxed on 70% of 200,000. That's 140,000. The applied carried forward losses is 140,000 minus the 50,000. So we have 90K taxable. 32% of 90K is 28,200. The net impact that we will have in our pocket is 171. Now fundamentally, this isn't significantly different from a net after tax gain to the current system, 168,000, right? However, the critical thing is the timing. So most people wouldn't be able to, one, hold 50,000 in cash flow in today's market, right? So if you wanted a property in Sydney, you could afford maybe 30, 20,000 negative, copping that out from your salary, but up to negative 50,000. And say you had another property of another negative 50,000. You can't build wealth, you can't compound. Whereas today, or in the current environment, what people have been doing is, because of this negative gearing, it has helped them. It doesn't mean that it is the end all or be all, because then you can tweak the strategy and change certain permutations and combinations so that you can get ahead and you can hold and you can sensitize so that you're not in financial stress, right? But holistically, what I want to hone in is that it is the initial holding cost that is quite critical in terms of the discipline of where you'll land. So again, if you implement certain structures, certain higher cash flow properties, for example, or if you actually putting in a bit more deposit, you can actually get more positively geared properties. So there's quite a few things that you can do depending on your individual circumstances and what you're starting from, and then from there work out what is best for your long-term goals and how to optimize that for yourself. But the second thing is the CGT, this extra 170k back in your pocket when you sell. It's all good and dandy if you do make a gain. If you make zero gain, you get zero. So what the government is incentivizing you to do, or the younger buyers, first-home buyers, is buy house and land packages off the plans, and especially if you get this wrong, and 9 out of 10 times the location and the suburb does the heavy lifting of capital growth, and most of the times these areas have oversupply. So what this means is you will purchase a property for 800, 1 million, 600,000, whatever it is, in terms of a new build, and over that period you will make zero gain, and so effectively there's basically no net profit after tax. And this is the thing that I want to hone in about, making sure we get a quality asset and think about the long term. So don't just invest in property to save on the tax. As we can see, high level, there isn't a significant difference, but it is the sequence with which we get into property investing. We educate ourselves and we get the right structures and the right advice to make sure the foundations are set for our financial future, if that makes sense. So it's quite important to really understand these fundamentally, and overall and overarchingly what the government is trying to do is obviously focusing on new supply. That's why they haven't been able to do it, and so they're looking at us in terms of the investors to try and build that new supply and incentivize that. But yeah, if there's any questions that you have, feel free to put in a comment or feel free to book a call with myself. I offer a free consultation for any questions that you might have, and happy to run through them with you. Thank you.